This episode is brought to you by Persona. The best fintechs expand what's possible for users. Persona does that for fraud prevention. Their recently upgraded link analysis tool surfaces connections in real time, letting you spot deepfakes, identity farms, and fraud rings during onboarding and investigations. They just published their Fraud Leader's Guide to Link Analysis, a practical look at today's top risk signals, automating decisions, and scaling link analysis for fraud prevention. Download it now at withpersona.com/FTT-fraud. Hello, and welcome back to the Fintech Takes podcast. Today's episode is a wonderful episode. I was lucky enough to be joined by Andrew DiMattina, product architect at Persona, and a longtime expert in all things fraud and compliance, particularly AML compliance. In this conversation, Andrew and I wanted to dive deep into the sort of changing state of compliance here in the US and around the world. You know, I think the expectation that a lot of folks had for this time under this administration was deregulation. And I think we've gotten that. But I think the actual experience of going through deregulation, particularly as it relates to areas like compliance and anti-money laundering, has maybe been a little bit more confusing and disorienting than we expected. Andrew and I talk about why that is, the effect that the federal government stepping back in some senses is having, the effect it's having on states stepping forward and playing a more active role, what we are seeing specifically around AML compliance, and the shift in terms of how examiners are working with the banks that they examine, the fact that compliance is still necessary because enforcement actions are still happening, even under this administration. We talk about that. We end, of course, by talking a little bit about AI, because, of course, we have to talk about AI and know your agent, which is its own set of interesting challenges. Overall, a fascinating conversation. AML in particular is an area that I've wanted to lean more into and learn more about. And Andrew was the perfect guest to help me do that. So without further ado, here is our conversation. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Andrew, thank you for coming on the podcast.
Thanks for having me today.
I am delighted to have you. We are going to nerd out on all things compliance, regulation, AML, KYC, which is obviously your wheelhouse.
Can't wait.
It's not mine. I'm more of an amateur, so you're going to have to sort of be my guide here a bit.
I bet you know more than you think you do.
Well, you know, I read a few regs, so put it that way. I at least try to go to the source on a lot of this stuff. And it's been interesting, right? I mean, I'm sure you found this to be true as well. The last 18 months have been a lot of stuff happening. And, you know, we were talking about this before we started recording, but I would kind of characterize it as really a shift almost into a different kind of almost like regulatory era, it feels a little bit like. And I hesitate to say that because obviously we know the pendulum swings back and forth and things never stay the same. And, you know, a couple of years from now, we could have a very, very different regulatory environment we're in. But it does feel like for a long time, there's been this sort of inherent tension on a couple of different levels, right? So one has been that, you know, I think we can safely say post-financial crisis, there's been a pretty strong like federal regulatory state just generally in the US. And this cuts across safety and soundness, prudential bank regulation, AML, KYC, consumer protection. But it's been, I think, a pretty strong federal regulatory apparatus with some variability, but generally pretty strong. And as a result, it has kind of been prominent in the minds and in the actions of banks and fintech companies. And then sort of secondarily, you had the states, right? And obviously, you know, we have the wonderful dual banking system that we have in the US. It creates all kinds of complexities and experiments of innovation in different pockets and things happening. But my impression at a high level was that in a lot of cases, the states we're sort of letting the federal government drive a lot of things and then sort of filling in around the gaps for different things that they particularly cared about. And you would see, New York or Wyoming or, California or whatever state kind of jump ahead of the federal government in certain areas. But broadly speaking, it seemed like Fed first, states follow was a rough framework for how to think about it. In the current environment, we have seen obviously a huge pullback from federal regulators, again, across a huge number of different areas. We have the CFPB kind of really just being defanged entirely. We have, new regulators in charge of the prudential regulatory agencies. A lot of those agencies are like losing staff and just sort of like slimming down. And what I've noticed is a real, like, strong and maybe in some senses unprecedented reaction from the states, where they're really stepping to the fore. And my naive assumption going into this new administration was that the states would step in, the federal government would step back a little bit, but I kind of thought that would look more like the states would step in and be a little bit more rigorous with enforcement, or would just be a little bit like tougher. I did not expect what I think we've been seeing, which is like new laws being passed in these states, new rules being passed in these states, new regulations being written, things that may outlast this current moment. And so I wanted to get a sense from you. I mean, you work a lot with, obviously, persona customers. You work with operators. Like, when a fintech company is operating in 40 different states, and we kind of have what's happening with this federal floor kind of disappearing or receding, how do these companies like define like what the standard is when it comes to identity and fraud or KYC and AML? Like, how do they approach that?
Yeah, it's a great question. It's a complex question, and it's a question we get all the time. And so
I'm sure.
I think in general, when we're talking to fintech organizations, every organization is sort of taking a different approach. But I kind of wanted to hit on your point about the federal role and the state role. Yeah, I've been in AML and KYC space for about 15 years or so. In my time in this space, it's always been there's more enforcement. There's more and more enforcement. You're going to have to do more and more things to meet your compliance standards. You're going to get $100 million fine. You're going to get $1 billion fine. You're going to get a $5 billion fine. You better do XYZ thing. And it feels like that's starting to change. Maybe, you mentioned that the pendulum swings back and forth. In my time, 15 years, the pendulum has really swung almost entirely one way, and maybe it is starting to swing back a little bit now. But it's creating a little bit more uncertainty than I think a lot of organizations would like, for exactly the reason that you mentioned, Alex, and that is the federal government may be relaxing some standards or changing some standards or giving guidance in a different way than it has in the past, but it isn't leading to a lot of certainty. And they're all, as you mentioned, there are also the state regulators. So I think typically what we've been hearing from our customers is they're paying attention to a lot of the changes that are out there. They're listening closely, but they aren't necessarily making tactical changes to their compliance to their programs at this point, because they do know that the states are there. There's other governments if they're operating outside the U.S. as well. And to your point, there may be a change in administration, and oftentimes, in many instances, the actual statutes aren't changing in any way either. Like, Congress isn't taking action on some of these things. So the laws on the books are staying. So that's sort of what we're seeing from a lot of our customers. A lot of them want to make changes. They see or they hear things in the news, but it ends up being where they are staying the course.
Yeah, I mean, I think that is wise, right? And I think that demonstrates a certain maturity in terms of like understanding that things will go back and forth. I mean, I constantly hear like, yeah, the look back period for that is 5 years, which extends beyond whatever this current moment is. And like, we don't want to create a problem for ourselves down the road, to say nothing of the fact that, like, I think in certain cases, a lot of these institutions feel like the programs or the controls they've put in place are pretty good and pretty effective and like work pretty well. And it's like, we think this is the right way to do this, more on like a normative level. And like, unless we're instructed to change it, we kind of, like what we have here. That, of course, runs up against, and obviously AML is your area, so let's dig into that for a little bit. It runs up against this broader kind of policy conversation that I am
Hmm.
hearing a lot about. And I've heard the heads of multiple federal regulatory agencies talk about this. Just in terms of like kind of performance, our AML regime does not work very well. Our money laundering regime it's not very effective at stopping money laundering. And that's always like the broader context for this. And what I've noticed is where other administrations or other regulators would sort of acknowledge that AML could be done better, they didn't really seem to want to translate that acknowledgement into like a real change in the way that these things are happening. Whereas, the current regulators, when I hear them talk about like, hey, AML doesn't really work that well, we should maybe be thinking more radically about like changing the way that this works. This hasn't shown up in like policy or guidance or new rules yet, but I do kind of get this just general sense that like there's more openness on the part of the regulators. And going back to your point, this might not be true on the institution side yet. They might be a little more cautious about doing it, but on the regulator side, it almost feels like they're sort of courting, like bring us ideas for like how this can work better. And we won't sort of hold you hostage to the way this has always been done in the past. Do you get that sense just kind of reading between the lines and looking at their comments and that kind of stuff?
Absolutely. Absolutely. I think I get the sense that this administration is listening to the organizations that it has been regulating, that have been saying exactly what you just said, Alex, and that is we're spending tremendous amount of money and effort and time
Yeah.
and labor and friction with our customers to meet these AML requirements. And we understand that an AML program is a pillar of foreign policy, and we're doing our best to help you know the country, but it's we're not seeing outcomes, and oftentimes the outcomes that an organization sees is they file a suspicious activity report, and they never know what happens with that, whether that leads to law enforcement action, and um, so I think what my sense is, and I haven't been close to this, but my sense is that the administration is listening to the regulated organizations, and is open to making changes, and is open to feedback from those organizations on how it may be done better. And you see that with some of the FinCEN notices that have been issued specifically this year, where they're talking about how technology organizations should be using more technology as part of their AML program,
Mhm.
and things like that. So I agree with you on that, Alex.
Yeah, I mean, it seems as though they're yeah, kind of trying to like almost embolden the industry to like take a different approach or to think differently about it, which, candidly, I don't think that's a bad idea. I mean, again, if you just look at the raw sort of baseline performance numbers on AML and these type of controls, they don't work very well. And so like we shouldn't be sort of mindlessly or thoughtlessly defending a system that doesn't really do the job that we set it out to do. You mentioned the word outcome, which I want to hone in on a little bit because, to me, one of the ways to sort of like contextualize this era we're moving out of and this era that we're now maybe moving into is a shift from process and checklists to outcomes. And again, like the regulators have been pretty explicit in describing this, right? I mean, Scott Besson at Treasury talks about, the fact that like we don't want this kind of traditional zero tolerance focus on process and documentation. Like if you don't follow every single process and have it all documented and capture every single thing, we're gonna, whack you on the wrist with a ruler, even though like none of that stuff has any real relationship to outcome. And shifting to more of a focus on like, all right, show us how you're actually putting controls in that stop this behavior, stop these activities that we're trying to get in front of. Practically speaking, how does a shift from sort of process and checklist and procedure to outcomes, like how might that actually play itself out on the ground with these institutions? Like it's fine to say that in a speech that you give at the Federal Reserve. It's a different thing to like actually operationalize that. What does it look like at an operational level?
Yeah, no, that's a great question. And as I mentioned before, sometimes an organization may not even know what the outcome of a SAR is or something
Right.
like that. So,
Right.
but I think it's interesting because AML compliance programs have sort of always been, at least for the last 15 years or so, risk-based program,
Yeah.
meaning how an organization treats one customer shouldn't be the same as it treats another customer if one is known to be a higher risk than others. And so it's kind of never been a checklist based exercise where you have to do X, Y, Z things for every customer or every transaction. But I think a lot of organizations have thought it to be that way, and maybe even the examiners that come in maybe have a checklist, and they're going through their checklist of things. Does this organization have a risk assessment? Do they have policies? Is their program actually, are they following their own policies? But they're going through a checklist. And so when there's a shift where FinCEN is saying we're going to shift to an outcomes based program, it's almost like it's not necessarily guidance to a fintech or a bank. It's almost like guidance to the regulatory examiners themselves. In a sense of like, you don't have to go through like necessarily your FFIEC exam manual and do your every single list that your checklist that you have there. It's more like look holistically at the program. Does the fintech or does the bank understand who their customers are? Do they have controls in place? Are they risk rating them? And then what are the outcomes? So it is interesting where the guidance is almost sort of like restating what already was in place. It's almost like but it's still perceived as a shift. So that I find fascinating.
This episode is brought to you by Persona. Fraudsters test your defenses until they find an opening. Then they attack. That's why link analysis tools like Persona's Graph are so important. They let you find users who share attributes like IP addresses, device fingerprints, or any other signal that your risk team might want to define. From there, you can shut down entire fraud rings and add link analysis checks directly into onboarding, so repeat attacks and copycats don't get a second shot. Learn more about how link analysis works and what makes Persona's real-time graph unique at withpersona.com/FTT-fraud. Yeah, that is fascinating because I guess to restate what you said, it's like we always told you it was not one size fits all, risk based, like we'll treat every sort of individual circumstance kind of differently. Yeah. That's what we always told you. That's what we always asked you to do. But behind the scenes, the examiners we were sending out in the field to sit with these institutions, it's almost like their bosses didn't give them that same latitude, right? And so I think that that shift, and I've heard this described as like one of the biggest sort of just broad-based shifts in bank supervision that we've seen in a long time, which I think is a good sort of framing for this, that like the way we supervise institutions needs to change. I wonder kind of how you think that will play itself out in terms of, I'm trying to think of the right way to describe this, like kind of the development of different risk profiles maybe. And I'll give you an example of what I mean. So, on the banking side, one of the things we saw under the last administration was a real crackdown on like banking as a service and partner banking, working with fintech companies. And what that example taught me was that the traditional model that I think regulators and supervisors and examiners had was a very rough approximation of like risk to size. So like as the bank gets bigger, its risk profile gets sort of more risky, and therefore you have to have more controls and more resources and more processes applied to that. But if you're a sufficiently small bank, you're not going to have that same risk profile, and so you don't need those same things. And what I think the modern financial services industry has, I think, hopefully sort of taught regulators over the last couple of years is size is no longer like a good one-size-fits-all metric for figuring out like how to tailor supervision or rules to different parts of the industry. Banking as a service and partner banks have a very big risk profile given their size, given the complexity and all the different programs. And some of them are dealing with like international or money remittances or just all these different things that you wouldn't expect a $800 million community bank in Kansas City, Missouri to be dealing with, right? And so like that type of profile, I think, means that we may in the future, if regulators take this approach, end up with like a much different segmentation for like where actual AML and compliance risk sits in the industry. That's not just like a sliding scale of small to big. Have you started to notice like pockets of areas where there's more concern or less concern?
Yeah, no, I think absolutely. I think that's spot on. A sponsor bank who is working with a fintech that's doing international money remittances is going to be exposed to much more risk than just like a large domestic bank, right?
Right.
But we were talking about enforcement actions and how we think potentially there maybe fewer enforcement actions, but it's kind of confusing because we are still seeing enforcement actions from this administration. Even just
one came out from the OCC
just this month, exactly, on the Community Federal Savings Bank, CFSB, in Queens, New York. They're a sponsor bank to several fintech organizations, including some remittance organizations. And they get hit. They get hit for things like not having a proper customer due diligence program, other AML issues. And so when we think of sort of like this deregulatory environment, at the same time, there are still regulators out there that are entering into consent orders with sponsor banks and other organizations for their AML deficiencies. So I don't know how to interpret it. It's confusing. I'm not going to lie. It's confusing to me. Like I said, I've been in this space for a long time, and it's really easy and simple when things are going in one direction, but things seem to be spinning in a circle and churn and all sorts of stuff. And so it's confusing. It's not sure how to interpret it all the time.
Well, I mean, I appreciate your candor because like sometimes the answer is, I don't know. I like this is genuinely confusing or contradictory. I mean, to pull on the CFSB example a little bit more, two other things about that consent order stood out to me. One is that it in some senses, it looked exactly like all the other BAS consent orders, right? Like your AML program is deficient. It's not able to keep up with all these risks. You have these particular programs that pose a risk that's very different than what this tiny little bank in Queens, New York would normally sort of be exposed to. You need to materially improve those controls. But in other ways, the consent order looked very, very different because previous consent orders under the last administration would pair those very specific AML critiques with more, I guess, sort of general critiques about like the board and how you're documenting policies and like all of these other sort of more like process-oriented critiques. And those were notably absent, I thought, from this consent order. And so I guess that kind of goes to the point of like, maybe this is a good example of the OCC kind of walking the walk and talking the talk, but like that seemed to be very focused on here's where your problem is. We don't necessarily want you to do a bunch of extra paperwork and documentation and training for the board or things that won't actually matter. We just want you to fix this part. The other thing that was very common in the old consent orders that came out of the last administration versus this one, and in this respect, I was a little surprised, and I'd love your take on this. There was no restriction on bringing on new programs, which I thought was fascinating. And so there's, under other consent orders that you would see under the last administration would be like, here are your problems, fix these, also do all that documentation process work. And until you do that, you have to get a non-objection from us if you want to bring on a new program. And I got to say, the non-objection to bringing on a new program thing always felt like a fairly reasonable requirement. Like, hey, this thing is broken. Don't go sell a bunch more of this until you fix the thing. And the fact that that was absent in this one sort of struck me as like maybe an example of where even this desire to like focus more on outcomes, there's also this desire, and we see this across stablecoins, we see this across AI. We're going to talk about some of those topics in a little bit, but like there's also this priority that we don't want to slow down innovation. Like we want you to keep doing things. We don't like want you to stop. And so all of the things we're talking about seem to have an overlay of, but don't stop growing, don't stop innovating, don't stop kind of pushing the boundaries. And I think for someone working in compliance, particularly AML compliance, that would make me feel like, gosh, I can't rest on my laurels because like my institution's going to want to continue to move fast. Our regulators are okay with us continuing to move fast, even if they identify material weaknesses in our controls. There's going to be no rest or break for me at all. Like the industry is just moving very fast from a competitive
No, I
perspective.
mean, that's a great point and a great observation. And I'm sitting here thinking about it from the perspective of a compliance professional, and my palms are getting a little sweaty because I'm
Right.
like, if you're a compliance organization at one of these places and you've been hit with a consent order, but the business has a green light to continue to expand and do new things, you're like, oh my gosh, how am I going to do this? Because I've been part of these,
Totally.
like some of the remediation projects at some of the
Yeah.
large ticket consent orders over the last decade,
Yeah.
the last 15 years or so. And I can tell you, the compliance department is 100%, 110% all in, nothing else on their plate except getting out of the consent order, spending all their time. And so just having to think about doing everything you need to do to get out of a consent order and also continue to innovate and perhaps, onboard like a new line of business or expand in a new line of business as well. I feel bad for the folks in the compliance department at that place.
Well, and I'm glad you mentioned that because I have not been in that seat,
Yeah.
so I haven't had that same like on the ground experience that you have. But it's a great point because the challenge then will be, all right, if push comes to shove, what do we prioritize? Do we prioritize getting out of this consent order, or do we prioritize continuing to support the business as it's growing? And it's funny, I had never thought about this until you said that, but and this might be a touch too cynical, but like, what is the incentive to get out of a consent order if the consent order doesn't restrict our business from growing or continuing to succeed? Like, could this just be one of those things where it's like, oh yeah, like we both have kids of roughly the same age. Like, yeah, Dad, I'll get to that. And you're like, will you though? Because it doesn't, like, you keep telling me that, but like, there's no teeth here, and so like, it doesn't feel like you're ever going to get around to it. So, I do think that is a really, really good point. That when, like, for a consent order to really matter for an institution, like for it to materially change how they approach doing this work, there is a bit of a stop, fix it, and then keep driving the car like motion that typically happens. And at least in the case of this consent order, that didn't seem to be almost how it was designed. I also, oh, I'm sorry, go
No,
ahead.
well, I mean, I was just going to say that a compliance program is there to support the business and help the business grow. And so if the business needs
Right.
to do that, then that's what the compliance program is there to do.
Yeah. I mean, it's the tail that wags.
Yeah.
It's not the tail that wags the dog, right?
Exactly.
Like the business is going to drive what the compliance folks work on.
Absolutely.
The other thing that I wanted to ask you
Yeah.
about is we're talking about these like small institutions, and by the way, this applies to fintech companies as well as to like community banks or banking as a service banks that are working with them. But like, if you're a sufficiently small organization, you can't throw bodies at this work, right? And this goes back to what you were saying before about the regulators seeming very focused on technology as a solution here. I'm curious to get your kind of just off the top of your head thoughts on where you think technology can have a big lift in terms of like making these compliance programs more effective and increasing the efficacy, but also making them so they're not as heavy of a lift. Because quite frankly, I think that's, and when I talk to bankers, they tell me this all the time. They're like, look, from an asset size perspective, we don't want to just incrementally get bigger. We want to like vault over certain thresholds because, as you get incrementally bigger, you hit these like invisible kind of points where different regulations or different supervisory expectations apply. And suddenly the amount of work you have to do doubles, even though your revenue didn't double when you magically crossed over that line. And it feels like the current administration is saying, look, we want you to find other ways to apply technology to make sure the efficacy of your program is really strong, but without having those like invisible points where the work just doubles all of a sudden because of these processes or check the box exercises or things that we might have wanted you to do before. Can you give us like a tangible example of what that might look like?
Well, I think you're exactly right. I think in order to scale, the only answer really is technology. And I'll tell you about what I see every day when talking to customers and prospective customers of that size. I am continue to be shocked at when we're talking to a prospective customer at Persona about their onboarding program, a customer onboarding program, and we say, well, what's your current process? And it's like, well, we ask them to email us, some documents, or we take a picture of their, driver's license at the branch or whatever, and then we put it somewhere, and it's basically, what I would call a manual process.
Totally.
And there are a lot of ways to improve. Yeah, I mean, that's a rough process for a lot of reasons, for data privacy reasons, for the labor involved in onboarding customers. And so there are a lot of technology products out there that can just quickly and accurately onboard customers that are good customers or good users, and identify fraudulent actors as well. And so, because as you scale, by the way, as you get more users and more customers, you're going to start to see the fraudsters come in as well.
Yeah.
So technology is really the only way that you can scale without throwing more bodies at something like as simple as a customer onboarding process.
Yeah, well, and I'm glad that you tied this to fraud as well, because I think another thing that we forget or we sort of lose track of a bit is all of the things we're doing from a compliance perspective. It can feel like checking the box or just like doing your homework or whatever. It can feel very disconnected, but really we're trying to stop bad people doing bad things. And bad people doing bad things oftentimes can relate to fraud or can cost you, the organization, money, or will end in a situation where there's a big fine or reputational damage or other things happening. And I will say that on the fintech side, I've been very heartened today relative to, say, 4 or 5 years ago. 4 or 5 years ago, it was like grow, grow, grow. Don't ask too many questions. Like there was a real misalignment in incentives between what a fintech company was trying to do from a business perspective and what regulators or even their bank partners would have wanted them to do from a fraud and compliance perspective.
Mm-hmm.
And I'd be curious for your perspective of this, because you've been in the space for a while. But my sense more recently is that even in the very early stages, a lot of fintech companies are thinking much more about like, okay, we want to grow, but we want to grow in a way that's not going to create like long-term risk or problems. We don't want to bring a bunch of fraudsters onto our platform. We don't want to create a big risk for our partner bank, who then may end up having to shut us off or take us off of the charter. And so I think that there's more of a long-term thinking that's kind of seeped into fintech from a compliance and a fraud perspective, and they are trying to invest in that technology earlier on, as opposed to like remediate problems that they kind of ignored, which seemed to be the model, 5 years ago.
Yeah. And I want to kind of expand on your point about bad actors doing bad things. I would say there's two types.
Yeah.
There's two types there. There's one, there's a fraudster who is there to take money from your organization or to scam one of your other users. And that creates, monetary losses or reputational issues for you. And then the other type is somebody who's trying to, launder money or finance terrorism or evade sanctions, and not potentially, hurt your organization directly, but it's really at a much broader scale, a much bigger scale, like a geopolitical risk or something that is against the interests of, in our case, the United States or whatever country you're domiciled in. And so you need to have programs for both, and which gets prioritized within an organization is always a fascinating discussion. Whether it's like, there's clear, direct monetary losses and user issues with fraud. But you won't, and then with money launderers and finance, the terrorist financing, it's not immediate direct losses, but it is a broader issue when it comes to compliance, a broader issue when it comes to, and it can have like huge, obviously, compliance and reputational concerns down the line. So there's technology, that can be used to mitigate both of those issues, but it is always a fascinating discussion on which to prioritize and which is more important.
Yeah, I mean, to use a really dumb
Yeah.
analogy to expand on your
Yeah.
point, because I think it's a really good one. It's a little bit like different recipes versus ingredients, right? So the core technology are the kind of core ingredients, right? And like you want the ability to assess identity and be able to assess identity in like a layered, nuanced, complex way. You want the ability to monitor transactions and to look for patterns in transactions. Like there's a set of core capabilities that you want. You want to be able to ingest external data. Like there's things you want to be able to do that feed into any type of risk management, really, whether it's credit risk, AML compliance risk, fraud risk, like they all sort of have the same basic ingredients. And from a technology perspective, I think any company, fintech, bank, what have you, should be investing in those ingredients. But the point you're making is a good one. Which recipes you choose to make using those ingredients and how much you prioritize those different recipes, that's what sort of shows the like relative priorities of different companies. And to your point, like the this is where my dumb analogy in particular comes in, but like the uh um ignoring the AML ones always kind of felt to me like someone who like skips dinner and eats dessert, right? Like I don't want to eat dinner. Dessert is way tastier. I get a nice sugar high from doing it. Like it feels really good, but you are sort of starving yourself of something more essentially important over the long term. And I kind of feel that way about AML compliance risk, where it's like, look, is this going to hurt your business? No. In fact, money launderers are in some ways really good, profitable customers, right? Like that's the kind of unpleasant thing to say out loud, but it is corrosive to the larger goal we all are engaged in at a kind of more of a societal level. And so I guess I'm mildly hopeful that if you have the really strong ingredients as a baseline, it doesn't take nearly as much effort to eat your dinner and to eat
Yeah.
dessert. But historically, I've seen that split very much in
Yeah.
organizations.
You're making me think of the old marshmallow test too, is with the kid with the
That's right.
marshmallow and like,
That's right.
if I can eat it now, or I can wait 45 seconds and have two. And, the kid always eats
Yes.
it now. Right. So making me think of that one as well.
It's 100%, 100%.
Yeah.
Most of my thinking these days on fintech relates back to my kids in some fashion. So that analogy will probably come up again. The other thing that is relevant, I think, to this discussion is that the perimeter of regulated activity keeps shifting or moving around, right? And so there's a few different examples of this. There's obviously just a flood of new bank charters being approved right now. We have tons of new companies becoming banks. In some cases, they're becoming sort of full service national banks regulated by the OCC. In other cases, they're becoming state chartered banks, sometimes with like novel state banking charters for specific types of activities. We've even seen the OCC approve like national trust bank charters, which are like for a slightly different set of activities. And what's fascinating to me about all of those, and then of course, like you have stable coins and the Genius Act and stablecoin issuers, like there's all of these new types of entities kind of crowding around on the edges. And what's fascinating to me is, again, this kind of tension that you see, right? Where the current, I think, administration and regulators, just as a general rule, want to bring in a whole bunch of new competition into the market. They want to throw the doors open to new charter types. But at the same time, and you and I were talking about this before we started recording, like as it relates to crypto and stablecoins, it doesn't mean that the same rules that we have now aren't roughly going to apply to you too. Like you might think it's kind of a novel thing. You might think, oh, like, this is about the sovereignty of money and the importance of decentralization or whatever. And it's fine to think that, but FinCEN doesn't think that way, and they're not going to think that way. And that doesn't really fundamentally change. The OCC just came out and clarified that if you're going to submit a bank charter application to them, they didn't say this in so many words, but basically it was like, please complete your homework assignment before you turn it in, because we're tired of like reading these half-assed applications that have no chance at passing.
If it's incomplete, we're going to give you an incomplete grade, basically.
Right.
Yeah.
And I would hope maybe like not accept an application again from you right away because you didn't show the care the first time in submitting it. So again, there is this tension between almost the policy objective right now, which is like bring more competition in, push the boundaries out further, like expand the regulatory perimeter. But also like these are safety and soundness regulators. These are people who fight money launderers. Like they're not going to allow these things to spin kind of wildly out of control. So what advice would you give if you were working for one of these institutions or working with one of these institutions that just sort of got inside the regulatory perimeter through one of these new doors that's been opened?
Yeah, it's a great question, and it's a fascinating it's fascinating to see all these organizations that are applying for charters and getting charters like really quickly. My general advice for any of these organizations is your compliance program needs to be just as strong as a compliance program from a bank that has had a charter for years, decades, a century. As far as I know, the Bank Secrecy Act hasn't changed. There's not a lot of changes, statutory changes.
That, Andrew. Right. Yeah, like if that had been repealed, I feel like we would have heard. Yeah,
right. And so, the administration may be, offering new charters, but there isn't a lot of change from Congress in terms of like an AML program or a BSA program as well. And so, as we were just talking about, like, you get in there, you want to expand the business, but definitely recommend having a strong compliance program in place as you do expand your business in that space.
Yeah, I think that's right. I also think that, in some senses, if you're getting a charter because you're doing some type of new novel thing, your risk profile day one might be much higher than your average bank that's just doing average bank things. And so, it is, I see a lot of these new charter holders that come in where they're like they're talking about like international remittances day one. And it's like, that's not a normal conversation for a normal de novo bank. Yeah. But if you are a sort of a crypto stablecoin sort of bank from day one, and you're going to explore all these other use cases and seek out demand in these places, your risk profile from a AML compliance perspective might be more akin to like a TD Bank or someone just massive who's been in the space for a long time and has all these different businesses. So again, it goes back to that kind of asymmetry of the businesses you're going after versus your size or newness as a bank.
Yeah, and you better have a good, strong risk assessment that shows you understand your business, you understand your customers, and you understand where the risks are, and then you have controls in place to meet those risks.
Yeah. No, I very much agree. All right, let's wrap up by just briefly talking about AI.
Oh, yeah, of course.
I'm constantly, I feel like I am constitutionally obligated to ask you about AI before I let you go. In 2026, that's what we have to do. So, obviously, I don't think anyone really knows anything on AI. So we're all kind of just speculating. But, this whole concept of like know your agent has definitely come to the fore. And, KYA is a very catchy acronym and a way of sort of thinking broadly about this challenge. Whenever I use that acronym in my head, I think of CYA, which is a different acronym that compliance people sometimes think about. So as it relates to KYA, though, what have you sort of seen as the initial discussions around this idea? Because just at a very general level, I think as it relates to like digital banking and mobile banking over the last couple of decades, the goal has basically been very simple and straightforward, which is this a human? Is this a bot? If it's a bot, like out, no, screened out. Clearly, we don't want to work with it. Like it's just no. And now, of course, if you have agents working on behalf of customers, you're going to have some legitimate bots. You're going to have some illegitimate bots. You're going to have some fraudulent bots. You're going to have some money launderer bots. Like you're going to have bots of all different kinds, and you need to distinguish between them. Just at a principles level, how are you and how are personas starting to think about that?
Yeah, it's a great question, and you're right that it's so early in the space, and it's hard to sort of think through some of these things. But I think at a high level, conceptually, it's exactly what you just said. It's one is like, is this a human or is this a bot, right? And if you're a human, then it's regular KYC, whatever. If you're a bot, it's no longer like denied. It's, are you authorized by a human to act on that human's behalf? And if so, who is that human that has authorized you to act on their behalf? Is that human a customer? Is that human somebody else? And then it is, what is that bot doing once they have access to your products, just like what is the human doing, like with a transaction monitoring program and other programs that we have in place. What is that bot doing? And so it is, very challenging to sort of think through some of these things, but that's sort of where we are in the early stages. It's like who authorized the bot, and then is the bot acting in a way that the human intended it to act?
So just to layer onto that for a quick sec, because I think that's a good way of sort of breaking it apart. Yeah. We still need to know that the human at the end of this is a human we're allowed to work
with,
right? So like that's one question that doesn't go away, right? Yeah. So like KYA does not get rid of the need for KYC would be one way of stating
right.
this.
If the human behind the bot is somebody on an OFAC sanctions list, that's not good, right?
Yeah, that's a bad human and a bad bot. Right. So we have to know that part one. Part two is that the human authorized the bot to do what it's doing.
Yes.
And to me, I think that's interesting because there's kind of a subtle distinction there that's important. I mean, you see this in fraud, you see this in money laundering, you see mules, right? Which is like a legitimate customer acting on behalf of another customer that's doing something that you don't want to do. You see account takeovers where, yes, it's this person's credentials, but they've been taken over by this other thing. To me, AI really expands the surface area of risk there, because now you could have ones where it's like, yes, this is a legitimate agent, this is a legitimate customer, but the customer didn't authorize the bot to do this, or the customer authorized the bot to do this other thing, but that authorization was intercepted and there was a prompt injection attack, and now the bot is doing a thing that the customer didn't authorize them to do. And then the question is, who is intercepting that bot, and are they on the OFAC list? Are they someone that we need to be worried about? And so like what I just described, there are like analog versions of that in like account takeover and muling and some of the things we've seen for a long time. But it feels like agentic AI is just going to rapidly expand the surface area for those types of topologies.
I agree. It's a crazy future, and it's kind of terrifying, to be honest. So
yeah.
We'll have to see what it entails.
Well, I know you guys are on it at Persona. Let's end with this question.
Sure.
Let's say like 18 months out, and we're sort of looking towards, I guess this would be kind of the end of the current administration after we've sort of seen this kind of agenda kind of play itself out entirely. How do you think we're going to be sort of defining compliance? Like what will that mean? Will it mean satisfying a regulator? Will it mean sort of being demonstrably good at stopping bad actors? Like, do you think we are going to continue to see this real meaningful shift towards an outcome way of thinking? Or do you think like regulators are maybe dancing around this, but it might just be a bridge too far for them to really fully embrace this direction that we seem to be headed in?
Well, it's a good question, and we don't know the answer to that, but I do think that there is clear guidance to sort of shift to that outcome-based approach. But whether or not that happens in practice is still it's TBD. But I do think that organizations should continue to I understand the risk of their customers and define their compliance programs to focus on the highest risk customers. And that should be, as long as you're making a good faith effort to identify those high risk users and monitor them and everything that you should be doing, you should be fine from a compliance perspective.
Yeah, it's interesting. I mean, I guess a way of reframing that is that like, you're not going to get in trouble for delivering bad outcomes or for delivering good outcomes. Like if you deliver good outcomes, you will be in good shape, regardless of how this environment changes, within, of course, the bounds of being able to know what a good outcome is, but continuing that good faith effort to try to clean things up and to make sure you're screening out bad actors. That's never a bad investment to make.
Absolutely.
Okay, awesome. Well, that's a great place to leave it. Andrew, thank you so much.
Thanks for having me, Alex.
All right, I appreciate it.
Take care.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.